Hello everyone, I'm CA Neeraj B. Welcome to my YouTube channel at the rate Accounting Buddy NB. In today's lesson, we will continue strengthening our accounting foundation by understanding some of the most important concepts used in real-world accounting and financial reporting. We begin with the duality principle and how every business transaction has two effects forming the base of the accounting equation and entire double entry accounting system. Next, we move to the very important topic of revenue recognition. We discuss in detail various business situations and understand when actually revenue should be recognized. The lesson then explains the concept of verifiable objective with direct and indirect verification examples. Further, we explore accounting standards and GAAP, including their objectives, importance, and relevance in international business. Finally, we discuss and conclude this session with practical questions and answers to improve conceptual clarity. So sit back, relax, and watch the full video. Principle of duality is also described as dual aspect. Dual aspect forms the basis of double entry system of accounting. I hope you remember we learned about double entry system of accounting in chapter 1 and chapter 2 videos. Whenever a business transaction or a business event occurs and is required to be recorded, there will always be two-side effect. One account is credited and another account is debited with the same amount. Now, to understand dual aspect, let us once again refer to the accounting equation, that is, assets are equal to capital plus liability. Let us clear the principle of duality with example. In example 1, Mr. X contributed INR 100,000 to start a business. Now, if we analyze this business transaction, capital of the business will increase by INR 100,000 and the cash, which is an asset, will also increase by the same amount of INR 100,000. At this stage, since there is no liability, accounting equation will look like cash, which is an asset, is equal to the capital. In example number 2, business purchased computers worth INR 60,000 and the transaction is settled by cash. This transaction will increase the assets of the business by INR 60,000 and at the same time the cash of the business, which is again an asset, will be reduced. Post this transaction, the accounting equation will look like the way it is displayed on your screens. Now we have two class of assets, cash 40,000 and computers 60,000. And please note the left hand side and the right hand side of the accounting equations are equal. I hope you remember cash is a current asset and computer is a fixed asset. We discussed these terms in detail in chapter number 2, basic accounting terms. Now in example number 3, the business took a bank loan of INR 75,000. As a result of this transaction, cash or the bank balance of the business will increase and at the same time the liability of the business will also increase by the same amount of INR 75,000. Post this transaction, the accounting equation will look like the way it is displayed on your screens. On left hand side, we have assets worth 115,000 in cash plus 60,000 worth of computers. And on right hand side, we have capital of 100,000 and a bank loan liability of 75,000. Total assets of INR 175,000 is equal to capital and liability for the same amount. Let us now learn the revenue recognition principle. Revenue of a business is recognized when it is earned and the business has established the right to receive the money, irrespective of the fact whether the cash is received or not. Let us now understand when a business is said to have earned it and the right to receive the money is established. Two conditions are very important. Number one, when the goods are delivered to the buyer as per the agreed terms and the seller do not have any control over the goods and the goods are no more in possession of the seller. Therefore, recognizing revenue and receipt of payment are two separate aspects of a business transaction. Now, payment for the goods sold can be received either in advance, that is before the delivery of the goods, or at the time of the delivery of the goods, or after the delivery of the goods. Let us take an example. If the value of the goods sold is say INR 50,000 and the goods are sold and delivered on 20th of May 2024, however, the payment is received after 2 months on 20th of July 2024. In this case, the sale is recorded as realized in the month of May and the transaction shall be recorded on 20th of May 2024 irrespective of the fact the payment is received on 20th of July. Let us take another example. If the value of the goods sold is INR 95,000 and the goods are sold and delivered on 22nd of May 2024, however, the payment was received on 15th of April 2024, that is before the delivery of the goods. In this case also, the sale is recognized in the month of May 24 and therefore the revenue will be recognized on 22nd of May 2024 even if the payment was received in advance. Let us take another example of cash sales. For instance, the goods worth INR 75,000 are sold and delivered on 15th of May 2024 and the payment is also received on 15th of May 2024. The sale in this case will be recognized on 15th of May 2024. With these three scenarios, I hope we have understood the revenue recognition principle. Verifiable principle says that the financial information should be based on objective evidence. In simple words, every financial transaction recorded should be verifiable either by documentary evidence or a process or a calculation as the case may be. Thus, this principle ensures that the financial statements are free from bias and the financial statements can be relied upon by the users. This principle ensures that without any exception, every business transaction should be evidenced and supported by a document. It also means that at all times, an independent accountant should be able to verify the business transaction. Let us now understand this principle with an example. Now, cash in hand of a business can be verified by actual count of physical cash in hand with the business to ensure that the cash in hand appearing in the financial statement matches with the actual physical cash. This is called direct verification. Similarly, the amount of depreciation can be verified by recalculating the depreciation basis the method of depreciation adopted by the business. This is an example of indirect verification. Another example we can take is of inventory. It can be verified by actual inventory count and the value of the inventory can be confirmed by applying a correct method of valuation. Now, the counting of inventory is a direct verification, while the recalculation of inventory value is an indirect verification. Let us now learn about the accounting standards. Accounting standards are the guidelines and principles designed to enhance consistency, reliability, and comparability in financial reporting. Purpose of accounting standards is to provide a framework for financial reporting that enhances transparency and aids in the comparability of financial statements across different organizations. There are three major objectives of accounting standards: consistency, transparency, and comparability. Consistency means to standardize the accounting practices and methods across different organizations. Transparency means to ensure that the financial statements provide a clear and truthful representation of an organization's financial position and its performance. Comparability means to allow users to compare financial statements of different entities and different periods. Let us now learn few important facts about GAAP. There is no one common GAAP across the globe, therefore GAAP adopted may vary from country to country. For instance, in US, the GAAP is defined by their Financial Accounting Board, FASB. All the US companies follow US GAAP. Many countries in the world follow International Financial Reporting Standards, which is popularly known as IFRS. IFRS is defined by the International Accounting Standard Board, IASB. IASB is aiming through IFRS to standardize accounting practices globally so that there is more transparency and improved comparability of financial statements across the globe. European Union countries, Canada, Australia, and several other Asian countries have adopted IFRS, but still many countries use their own local GAAPs. In India, Indian Institute of Chartered Accountants have issued the Indian Accounting Standards to standardize the accounting practices in India. So a business which operates in US will follow the US GAAP, while a business which operates in India will follow the Indian accounting standard for preparing their financial statements. Let us learn few facts about accounting standards from Indian context. The Institute of Chartered Accountants of India had set up the Accounting Standard Board ASB with the following objectives. Number one, to identify the areas where alternative diverse accounting practices were followed. Number two, to bring uniformity in accounting practices. Number three, to recommend best accounting practices. And number four, to develop accounting standards keeping in view the business environment and relevant portions of the tax laws in the country in order to facilitate the accounting which is in line with the relevant tax laws in the country. The process which is followed for finalizing and releasing an accounting standard involves below 6 steps. First is the research, under which the purpose is to identify and analyze the issues and the requirements of the facts which needs to be standardized. Publishing proposed standards for public comments. Number three, gathering feedback from stakeholders. Number four, issuing the final standard based on feedback and further analysis. And finally, post finalization, issuance of the standard for its implementation. There are three sets of accounting standards which are followed in India. Let us understand their respective applicability. Number one, accounting standards issued by the Institute of Chartered Accountants of India. Accounting standards issued by ICAI apply to non-corporate entities. These standards are not backed by law. They are implemented by ICAI through their members who audit and issue audit report for such firms. Second set of accounting standards is popularly known as Indian Accounting Standards. It is a set of accounting standards which ICAI recommends to the National Financial Reporting Authority. NFRAR is an authority under the Companies Act 2013, and NFRA notifies the list of accounting standards to be applicable to the companies. Indian accounting standards are applicable to following category of companies: the companies which are registered in stock exchange, the companies which are having a net worth of INR 250 crores or above, holding subsidiary and associate companies preparing their financial statements following Indian accounting standard. Third set of accounting standards is applicable to the companies which are registered under Companies Act 2013, but they are other than those companies on which the Indian accounting standards are mandatorily applicable. Other companies for whom Indian accounting standard is not mandatory by law can also follow Indian accounting standard. Now the businesses are required to publish their financial statements in accordance to the accounting standards followed or applicable to them. Financial statements which are prepared are 5. Number 1, statement of financial position, statement of change in equity, statement of income, statement of cash flows, and the notes and significant accounting policies. Let us answer few questions related to the topics which we have discussed in this video. Question number 1, explain dual aspect concept. The answer is every transaction has two aspects, a debit and a credit of equal amount. According to this concept, for every business transaction, both the aspects are always recorded without any exception. Question number 2, explain revenue recognition concept. The answer is revenue is recognized when it is earned and the right to receive the money is established, regardless of the fact when the cash is actually received. Question number 3, explain verifiable objective principle. The answer is according to this principle, the business accounting should be free from personal bias. Every business transaction should be verifiable at any point of time. Question number 4, explain the word accounting standards in brief. First, the definition. Accounting standards are the guidelines and principles designed to ensure consistency, reliability, and comparability in financial reporting. And the purpose is to provide a framework for financial reporting that enhances transparency and aids in the comparability of financial statements across different organizations. Question number 5 on your screens is, what are the main objectives of accounting standards? The answer is, first objective is consistency, to standardize the accounting practices and methods across different organizations. Objective number 2, transparency, to ensure the financial statements provide a clear and truthful representation of a company's financial position and performance. Number 3, comparability, to allow the user to compare the financial statements of different entities and periods. Question number 6 is, write a brief note on accounting standards. The answer is, Institute of Chartered Accountants of India recommends accounting standards to the National Financial Reporting Authority. NFRA is an authority under the Companies Act 2013, and NFRA notifies the list of accounting standards to be applicable to the companies. Indian accounting standards are applicable to following category of companies. Number 1, listed companies, the companies whose shares are listed in the stock exchange. Number 2, companies having a net worth of INR 250 crores or above. And number 3, holding and subsidiary and associate companies preparing their financial statements following Indian accounting standards. Question number 7, name all the financial statements prepared by a company on which the Indian accounting standards are applicable. The answer is statement of financial position, statement of changes in equity, statement of income, statement of cash flow, and the notes and significant accounting policies. My next lesson on 6th of June 2026 is a 60+ question and answer session in which we will test and strengthen your understanding of the most important accounting principles accounting concepts, guiding rules, GAAP, IFRS, and accounting standards through a carefully structured series of questions and answers. This lesson will cover critical thinking questions, short answer questions, one word answer questions, and business scenario based questions, and also true and false questions. If you enjoy the content of my channel and appreciate my teaching style, please subscribe, share, and like my YouTube channel @AccountingBuddyNB. Thank you and goodbye for now.